Okay, so good morning, everybody. I'll start off with an update on the 2023 budget. We'll just go over both personal measures and business measures. Not too much in the budget. There are specific topics, two in particular, that I'll maybe touch on a bit more than the others because they have some importance there. And then after I'm done with the budget, Krista will take over and talk about the new UHT, which is the Underutilized Housing Tax that has been introduced, plus some other measures all relating to, again, unutilized residential homes. So moving on. So on the personal measure side, again, there were no changes to the personal tax rates. We'll talk a bit about changes to the alternative minimum tax. Again, some minor changes to deductions for tradespeople, tool expenses, RESPs, RDSPs, and then a grocery rebate. So what is alternative minimum tax? So basically, AMT, essentially when you're filling out your personal tax return, there are actually two computations going on. There's the computation that pretty much everybody sees on their tax return. So, you know, the income inclusions, deductions, and the computation of the tax on Schedule 1 for the federal and then the provincial. However, there's also a second computation going on, which is basically formula driven, whereby at the end of the day, at minimum, you need to pay essentially this alternative minimum tax. So typically in a normal circumstances, the regular calculation of tax typically is always more than the AMT. So that's why a lot of people are not even aware of the AMT. Again, just because under normal circumstances, the regular, if you like, computation always ends up being more than the AMT. However, there are scenarios typically where somebody's income may be in a given year may be substantially made up of, for example, capital gains versus earned income or dividends. So when you have those situations, AMT can actually be more than what the computation under the regular rules would be. So you end up paying this alternative minimum tax. So what the government has done in this budget, they've proposed to change the computation of alternative minimum tax, which would essentially trigger more tax, and it's targeted towards higher earning income individuals, such that essentially you'll get your AMT will end up in a higher result, if you like, than it would be today. So under current rules, the tax rate under AMT is a flat 15%. So they're looking to increase that to 20.5%. There's an exemption limit for the first 40,000 of income under the AMT calculation is exempt from tax. So they're actually bumping that up to 173,000. But where the computation changes, so although they're increasing the exemption, which would typically say, okay, well then the calculation will be lower, they're increasing the rate, but they're also broadening the scope of arriving at the taxable amount for AMT purposes. So a few of the changes, for example, capital gains, whereas under the current circumstances, in calculating AMT, you would include 80% of the capital gain. Now you have to include 100% of the capital gains. Again, under the regular computation, you're actually including 50% of the capital gains. So again, they're broadening the scope under AMT purposes. Capital losses, for example, whereas before you were able to deduct for AMT purposes 80% of losses, now you're only going to be allowed to deduct 50% of the losses. So again, that whereby increasing the basis for the AMT calculation. Similarly, certain deductions, you're only going to be allowed to deduct 50%, and that would be any employment expenses, childcare expenses, moving expenses. So again, right now, I believe you can get, it's either 80% or 100% at the deduction, whereas now they're going to cap it at 50. So again, this does not impact the way you would calculate your regular tax computation. So again, not many people do get impacted with AMT, but again, under the new AMT rules, again, the basis for the computation is a lot more broad now. Again, this would impact more persons who have income derived from capital gains. So in a scenario, if you have a business like a corporation and you sell the shares of your corporation for capital gains purposes, that's where typically you'd see AMT kick in, or where an individual's income is substantially made up of investment income. Now, AMT is also a what we call a provisional tax. So even though you're paying it today, you can actually apply it against future tax liabilities up to 7 years. So again, you pay the AMT to get today, as long as you have tax liabilities in the future and generated mainly from earned income, you'll be able to apply the AMT you pay today against that future liability up to 7 years. So the time limit to recover the AMT has not changed. It is still 7 years. And these new rules would apply effective 2024. When it comes to the tradespeople, so tradespeople, they're essentially allowed to take a deduction for any new tools they purchase. The amount used to be $500. They're looking to up that for 2023 and subsequent years to $1,000. So basically, you know, any person in the trades industry would be able to deduct up to $1,000 of new tools acquired for their business. When it comes to registered education savings plans, again, really what they've done is they've increased the amounts that a student would be able to pull out from the plan. So for full-time students, for the first 13 consecutive week enrollment in a 12-month period, they're looking to increase the amount they're able to draw from the plan from $5,000 to $8,000. And for part-time students, per 13-week period, they'll be able to draw $4,000 versus $2,500 per. So some other changes. Right now, it's only spouses that are allowed to open joint RESPs for their kids. So there are proposed changes to enable divorced or separated parents to also open joint RESP accounts for one or more of their kids, so that they can both contribute to the same plan. And then from a HST, GST rebate, again, this is a one-time thing, just again to help with the increase. This is kind of a tailing off from COVID, and due to the high increase in standard of living, cost of living, again, increase in groceries. So what the government has done is a one-time HST rebate, which they're calling the grocery rebate. And what it is, so right now for persons earning modest incomes, there is a GST rebate. For singles, it's up to $467. And then for married couples, it's a 612 plus 161 per child. So the grocery rebate would be amount equal to half those amounts, and they'll be paid out once the legislation is passed. Again, this is just a one-time thing. Moving to business measures. So on the corporate side, again, there were no changes to the corporate tax rates. Something which is of interest is the intergenerational business transfers. So I'll spend a bit of time on this one. So essentially, what happened in the past was when an individual wanted, when an individual wants to sell, let's just say their business, and we're talking about shares of a corporation. So you have an active business, you want to sell your business, you're able to sell the shares of your company to a non-related third party and claim your capital gains exemption and get capital gains treatment on the sale of the shares, reducing your overall tax liability. However, the rules, the way they were, did not allow you to sell to a corporation. So you sell the shares of your corporation to another corporation that was owned by a related party. And because if you did that, the capital gain would actually have been converted into a dividend. So you would not be able to claim your capital gains exemption and essentially pay tax as though you've paid yourself a dividend. So it was very, it was essentially you get penalized for selling your business to a related party. So the government looked at this and they said, well, why should it be that way? Why should, for example, parents be penalized if they want to sell their business to their children? So they changed the rules, and essentially now you're able to sell the shares of your corporation to another corporation owned by related parties, essentially to your children, and they extend the definition of child, which I'll get to. But so essentially, basically now you can sell to a corporation that's owned by a child of yours without being penalized. And there are certain conditions that have to be met. One, the shares of the company you are selling have to be qualifying small business corporation shares, meaning they have to qualify for the capital gains exemption. Two, the purchasing corporation must be controlled by an adult child of the transferor. And again, the definition of child has been extended for the purposes of these provisions, which include child, grandchild, stepchildren, children-in-law, nieces, nephews, grandnieces, and grandnephews. So if you sold your shares of a company to any of these persons, or a corporation owned by any of these persons, again, you will not be penalized going forward. Some additional conditions that they require is that the actual business does transfer over, because initially, when they had initially issued some of these rules that changed these rules, there was no mention as to whether the actual business has to, the control of the business, if you like, has to change also. So you could have transferred the shares to a corporation owned by your child, but the parent may maintain control. So they added conditions to say, there's two tests. You could opt under two, but basically either over like a 3-year period, the control of the business has to transfer also to the child or children, and basically treated it as though it is an arm's length sale, or else there's a 5 to 10 year test, is what we call a gradual business transfer. And that's typically based on a traditional estate freeze, where we would typically freeze out the parents and then, redeem their shares or buy back their shares over a period of time. So as long as again, the the sale to the children happens under one of these two conditions, then again, the parents are able to claim their capital gains exemption and won't be penalized for again selling to a related party. Moving on, a lot of incentives relating to clean energy. Again, so there's introductions of new and modifications to existing incentive tax credits. I won't go through the details of each, but we have clean electricity investment tax credits, clean hydrogen investment tax credits, clean technology investment tax credits, again, related to carbon capture, utilizing and storage, and clean technology manufacturing investment tax credits. And these are all tax credits to essentially incentivize companies and businesses to invest in clean energy. One other change from a business perspective, and this really impacts only public corporations, where typically we basically, sometimes corporations will redeem their shares or buy back their shares. So in a private corporate enterprise perspective, if a corporation buys back or redeems shares that it owns in another corporation, there's a deemed dividend on the redemption. That dividend can flow through essentially tax deferred from one corp to the other. What this proposed provision is doing, essentially, it's for public corporations only. It's basically adding a 2% tax on the net value of these share repurchases. It would not apply to private corporations, would not apply to mutual fund corporations, but will apply to REITs, which are real estate income trusts, SIF trusts, and partnerships that are trading on the listed stock exchange. And then also, similar to I mentioned before, there's dividends, again, between one corp and another can flow through tax deferred. The government's looking to impose a tax on any dividends that are received by a financial institution. Again, this typically won't impact any of our clients. This is more for the banks and bigger financial institutions. And I think, yes. So then the one last business measure that we talk about is GAR. So what is GAR? Essentially, they're the General Anti-Avoidance Rules. So the Income Tax Act currently, and they've been there for a number of years now, there are rules in there that basically prevent abusive tax avoidance transactions while not interfering with legitimate commercial or family transactions. So essentially, what the government does not want is people to use the Income Tax Act with the primary reason being to avoid tax. So even though you may carry out transactions that are within the legislation, if the sole purpose or the primary purpose of the transaction was to avoid tax, then basically they're saying that's abusive, and basically under the GAR rules, if the transaction is deemed to be abusive, they would essentially deny the tax benefit created by that abusive transaction. So the proposed rules are essentially, again, broadening the scope where GAR would apply. So under current rules, they're saying GAR would apply where the primary purpose of the transaction is to achieve a tax benefit. Under the proposed rules, they're saying, as opposed to the primary purpose, they're saying one of the main purposes, so is for to basically obtain a tax benefit. So whereas before it was the one primary purpose, now if it's one of the main, so you could have multiple purposes, but if one of the main purposes is tax, they can apply the GAR rules. Again, these rules haven't gone through yet. There's been a bit of discussion on them between the institute, the tax foundation. So, because again, I mean, at the end of the day, any transaction we do from a tax planning perspective, there's always the tax benefit at the back of every transaction. So, again, what we need to look at is making sure that there's an economic reason for the transaction in addition to tax benefits. So again, they're going to look at the economic substance of a transaction. But again, we'll have to see what they come with once all the discussions have been had, and there's no draft legislation yet on this either. In addition to that, they're proposing a penalty, again, to discourage people from implementing aggressive tax planning transactions, but they're looking to introduce a penalty of an amount equal to 25% of the taxable benefit received from the abusive transaction. So again, this is, pretty harsh penalty on transactions. So again, we'll see what comes out of this once we have more information. And at this point, I will hand it over now to Krista to talk about the UHT. Thank you.
Thanks, Richard. Good morning, everyone. So there's 3 topics that I'm going to speak about this morning. They're all very similar. The first being UHT, which pretty much affects all of Canada. This is a federal legislation that's been implemented. Then there is the vacancy tax, which has currently impacted residents of Toronto and Ottawa, and it also exists out in Vancouver, but it will be coming to more regions projected in 2023 and 2024. And then lastly, I'm going to be going through the ban on foreign buyers that the government has implemented as of 2023. So the UHT was introduced in June of 2022, and it is applicable to all of calendar 2022 and future years. The tax applies to vacant residential properties held by non-citizens and non-permanent residents. So this does not apply to commercial properties. It only applies to residential properties. Individual Canadian citizens and permanent residents do not need to file. So this is Canada-wide, but if the property title is held personally, so in an individual's name, and that individual is a Canadian citizen or a permanent resident of Canada, they do not need to file the UHT. They do not need to worry about any tax. And that's no matter what the status of the property is, whether it's vacant, whether it's utilized, it doesn't matter. If it's an individual that holds the property, they don't need to file. Canadian trusts, partnerships, and corporations do need to file. So this is where a lot of our clients are impacted. Any private corporations that own residential properties will need to file the UHT. Note that there's likely no instance of tax. There is an exemption, which I will get into a little bit later, but the filing is still applicable. So for those that are impacted by the tax, it's a 1% tax on the greater of the MPAC value. So that's your property tax assessment value and the value at date of purchase. Right now, the MPAC values are typically very far behind unless the property has been held for multiple years, 30, 40 years. So typically you're looking at what you paid for the property. That's likely what you're going to be paying the tax on. There are penalties for failure to file, and there are exemptions available. So the intention of this overall is to deter non-Canadians from holding vacant residential property. So the government doesn't want anybody just parking their money in Canada and then not utilizing that property since we have such a housing shortage. So the due date filing, or the filing due date, is April 30th of each year. They couldn't have picked a better day. I know that accountants have nothing to do on April 30th. So For this year, it's April 30th, but they were kind enough to grant us an extension because it was implemented so quickly. So right now, the UHT filings for 2022 are not due until October 31st, and there will be no penalties or interest applied as long as the filings are in by that date. So again, who needs to file? So anyone or entity that owns Canadian residential property that is not an excluded owner. So I've listed out excluded owners. So your excluded owners are an individual Canadian citizen or permanent resident, any public companies, registered charities, cooperative housing corporations, and a few more. So if they are not an excluded owner, you need to file. So that includes non-resident, non-Canadian individuals, Canadian trusts, partnerships, and corporations, any foreign corporations that are private, and all other owners that don't fall into those categories, but also don't meet the excluded owner test. So the tax is a 1% on the greater of MPAC and the cost of the property. The penalties for failure to file, this is where the exposure is going to lie, especially for those that have corporations that hold residential properties. For individuals, it's a greater of $5,000 and a small calculation, which is based on the UHT tax. So basically, if you're an individual, you're looking at a minimum penalty of $5,000 since the calculation is greater of. For other individuals, which includes your corporations, partnerships, and trusts, it's $10,000. So you're looking at a minimum $10,000 penalty if you do not file, even though there is no instance of tax. And these penalties are applicable on a per property basis. So if you have 3 residential properties in a corporation, that's a $30,000 penalty if the filings are not made, even though no tax is applicable. And of course, in typical CRA fashion, all penalties are also subject to interest. So they'll get you with the interest inclusion, which is currently 8% on any failure to pay the penalty. So exemptions from the 1% UHT tax. So as I mentioned, Canadian corporations, trusts, partnerships are not going to have to pay the tax, but they do have to do the filing. So on the actual UHT filing, under the exemption section, there is a tick box for a specified Canadian corporation or a specified Canadian partnership or Canadian trust. So that would be the exemption that most business owners fall into. When it comes to actual non-residents, there's a whole list of other exemptions, one being primary place of residence. So if an individual that technically say they live in the States, they're not actually residents of Canada or citizens of Canada. If they have a temporary work visa and they're coming here for 6 months of the year and they buy a place to live in while they're here working, the primary place of residence, that's an example of when that would be applicable. Qualifying occupancy. So of course, if the property is not vacant and it has tenants, still a requirement to file, but there would be no instance of tax. If it is a vacation property, so this is very specific. It cannot be a vacation property in Toronto because that's outside of a census metropolitan area, a CMA. But if you have a vacation property in Muskoka or somewhere a little more rural, it may qualify, and then you only need to live there for 28 days of the year. It doesn't need to be consecutive, but as long as the individual is going to the property for 28 days, it will qualify as a vacation property. And then we have a couple more, which are basically based on the assumption that it can't be lived in year round. So residential property is not suitable for use. Maybe it's not winterized, or maybe it's seasonally inaccessible. Maybe nobody maintains the roads, and in which case that can be an exemption, as the property isn't available for use all year round. So therefore it wouldn't be a property that technically could be lived in all year round. And then there's an exemption as well for an owner that died in the calendar year or the previous year. If the residential unit is unoccupied because somebody passed away, there is an exemption for the year or the previous calendar year. This is not an exhaustive list. There are a couple other exemptions. They're probably not going to be used as often, but if you are in a situation where you are not a permanent resident or you're not a citizen of Canada and you have any questions, you can always let us know. And again, to reiterate, the filing is still required even if an exemption is met. So it's important to get the filing done. So some final notes, just on clarification of what UHT applies to. Residential properties are defined as 3 units or less. So apartment buildings, so not condos, but large apartment buildings where the individual units would never be sold off. Everybody in their unit pays one landlord rent. That would not be considered a residential building. That would be considered more of a commercial building. So if you have a complex that has 4 or more units and they can never be condominiumized, then UHT does not apply. However, if the building is a condo and say you own a floor, say you have multiple units in a condo, but you could potentially sell all of those units off individually, you would require an individual UHT filing for every single unit. This, of course, can be, I have a note here that it's very problematic for any builders that have substantial completion, but the title has not been transferred. They will be required to file a UHT filing for each individual unit. I know that their governing body is really pushing to get exemptions for builders, so we'll see where that goes. But right now it's a little too early, so we're kind of advising our clients to do it just to be safe. And again, just to reiterate, a UHT return is required for each individual unit. So that kind of wraps up the UHT, which is a good lead into vacancy tax. If anybody here lives in Toronto, you may already be familiar with this. The vacancy tax is similar, but also very different. It's its own legislation. It's municipally implemented. So I have some examples here for Toronto, but to note that if you live in a municipality that has UHT potentially coming into force, so Durham, Hamilton, Mississauga, they're all kind of whispering that this will be applicable for 2023, 2024. It is very important that you read the exemptions and legislation of that municipality because every municipality will be different. So the big difference with this one is that every owner needs to file this declaration. It doesn't matter if the house is held individually or if it's your principal residence. Every individual owner needs to file a declaration for every residential property that they own. I know that Toronto was facilitating this electronically, so all the residents basically received something in the mail and they had to go online and fill out this declaration. It's very simple, but comes with very steep penalties if it's not completed. So again, similar to the UHT, it's a 1% tax on the MPAC value. And the rate could increase. So I have a note here that Vancouver is currently 5% tax as of 2023, and they did pass that. However, I just read an article yesterday that they're actually looking to reduce it back down to 3% again. But in any case, right now it's 1% in Toronto and Ottawa, and we'll see what happens there. There are penalties for failure to file, and again, there are exemptions available. These exemptions are a little bit different from UHT. And again, the whole premise is to defer people from holding vacant residential properties, parking their money, and not actually renting out the units. So who needs to file? Any and everyone. Anyone that's on title of a residential real estate property needs to file. Basically, I think there's actually 5 categories on the Toronto form, but they all fall under whether the property is your principal residence, whether it's tenanted or whether it's vacant. So you have to self-declare. I'm not quite certain what the audit rate will be. I think that it was rumored that they were going to try to hit 5% in the first year. But we'll have to see, you know, I'm interested to know what kind of capacity these municipalities actually have to properly audit these declarations. The due dates will vary by municipality as well. So Ottawa's deadline was March 16th this year, and Toronto's deadline was February 28th. So they all seem to be in the first 2 to 3 months of the following calendar year. Penalties for failure to file, not as significant as the UHT, but still significant, especially if it's your principal residence and you live there. So $250 for a late declaration. It can go up to $10,000. Plus the property will be deemed vacant. So this is the big one. If you do not declare, they will deem you to be vacant and they will assess you a 1% tax on the impact value of the property. And from what I've seen, there's no way to get out of it once they've done this. I've read a couple articles of people that are really struggling to fight it, and they're not budging. So the tax will be imposed even if it's your principal residence if you fail to submit the declaration. And just a note on how the program is administered. So any balances will be added to the property tax assessment, and it's all collected through the property tax, the MPAC. And again, always subject to interest. So get in those declarations if you live in those municipalities. There are some exemptions, but I'll go through very quickly. Death of an owner. So if somebody passes away in the year, if the property is vacant due to a significant renovation, I think that's only allowed for 1 year. I don't believe you can do that for multiple years in a row. Principal resident is in care. So if the house is vacant, but the owner is in a nursing home or another care home, there is an exemption for that. Transfer of legal ownership in the year. So if the property changes title, the year you buy it, you are exempt. If the property is required for employment, so this is if an individual lives, say they, I don't know, live in St. Catharines and they live in Toronto and they need a secondary home in Toronto for employment purposes, it can be an exemption. And vacant due to court order. So if there's any legal ties to the home, there's an exemption for that. And again, form is still required, even if there's an exemption. So just a couple of considerations, and this comes out of what we've heard on the Vancouver tax. If you do have rental properties, especially in Toronto, so where this tax may not apply to you, provided you get your declarations in and all is well, you want to be making sure that you have proper documentation in the instance that there is an audit. So we were kind of just hearing horror stories that landlords were being audited, and even though they had a lease, the tenant was not cooperating and wouldn't prove, and they couldn't prove that anybody lived there other than the lease because they wouldn't talk to the municipality, and so landlords were being assessed vacancy tax even though there was somebody living there. So we just say good practice is make sure that your tenants are putting utilities in their name so that you have something more than just a lease agreement that has no identification other than a signature. Also, one that came up that was big was individuals buying properties for their kids that are going to university in Toronto or Ottawa, and they don't change their address. So there's no way to prove that anybody lives there because their child keeps their home address at their home. So if that's the case, you want to make sure that you're looking out for yourself and make sure that you have proper documentation to concretely prove that somebody lives there, so that you're not charged that vacancy tax for no reason. Okay, I'm going to see if I can get through this in 3 minutes. So non-resident buyers ban. I don't think this is going to impact very many people here, but this is really just a topic of interest, maybe. So basically, the federal government put a 2-year ban on non-residents acquiring real estate. So this only applies to real estate outside of those CMAs or inside of the CMAs. So non-Canadians can purchase real estate outside of CMAs, so they can buy something way northern Ontario, that's okay, but they're not going to be able to buy any property in Toronto. There are, however, a couple exemptions, which I'll go through quick. And the penalties, if they find a lawyer that goes through with the purchase, basically there's a $10,000 penalty, and the courts can force you to sell the property. So some of the exemptions or exceptions are temporary residents studying in Canada. However, the property cannot be more than 500,000. So especially if you're in Toronto, you're not getting anything more than a bachelor or maybe a 1-bedroom. Temporary workers in Canada can purchase, but they must be able to prove that they're going to be in Canada for more than 183 days and they have a valid work permit. And refugees who've been granted protection under the Immigration and Refugees Act can purchase. That's different than immigration. Obviously, refugees are a little different, so they also have a carve out. And that is all I have for those 3 topics. So I guess we'll open it up to any questions.
Yeah, thank you, Krista. Yeah, so we have a couple of questions here. And first, going back to the first part of the presentation, the budget. So one question, they're asking how much the grocery rebate amount is. So again, the grocery rebate amount is half of what the goods and service tax credit is. So right now, for an individual, the GSTC, which is the GST tax credit, for an individual is 467. So the grocery rebate would be half that, which is 233. For a couple, would be $302 plus $80 per child. And again, that would be paid out once the legislation's passed. And then a second question, basically on the intergenerational transfers. The question is, in the event of parents transferring the business or selling the business to their children, do the parents have to seize control? So again, as I mentioned, there are 2 additional conditions that they introduced, which are basically 2 transfer options. The first one, again, being what we call an immediate business transfer. So control has to transfer to the kids within a 3-year period. So, and really the logic behind that is in any, even when you're selling to a third party, like a non-related third party, many a times the new owners would ask that the previous owners stay on for the transition. So similarly with transferring to your kids, they say within a 3-year period, that's kind of the transition where the parents would transfer over full control. Under the second option, which is what we're calling a gradual business transfer, again, it's a 5 to 10-year test, where again, typically the parents are, as opposed to having a full immediate transfer, the parents are frozen out, so their value in the business is frozen. The kids get future values, start to take control, but typically the parents want to remain in control until 1, they get paid out, and 2, they want to make sure that the children have a good handle on the business. So eventually, yes, the parents have to seize control, but it's under one of those 2 options. And then on the 2 questions for you, Krista. One is, if somebody owns a duplex in a corporation, like, do they have to file 1 UHT form? Like, what's the filing requirement for a duplex held in a corporation?
So that a duplex that has, like if the residential address is say unit 1, unit 2 of 100 123 Street, I believe you would need one UHT filing. Because it's a registered duplex. So you'd only need one for an individual unit, a duplex or a triplex. But you need multiple forms if you hold multiple properties.
Okay, and then a second question relates to, I guess, ownership. So if a husband and wife own an investment property, is that personally, not through a corporation, is that considered to be a partnership? And does it make a difference if it's owned in joint tenancy versus tenants in common?
So
And
this is still gray. We don't have legislation on this yet. So just not to be a pessimist, but the legislation for this was very poorly executed. There were a million questions when this was rolled out, and this is one of them. And I still don't think that we have clarification on this. If what I would say to the person asking this, I'm assuming this is probably your personal situation. If it is short-term residential, so that you have HST, I would probably file a UHT return. If you have a joint HST, if it is long-term residential and you have one tenant, and so the residential is not the residential income is not subject to HST, I think that you would be okay not filing because you're both individuals and you have joint ownership.
I would add to that, and this is not necessarily only in a husband-wife situation, but let's just say two individuals. I think, and again, there's no legislation on this, but I think just a bit on, what's the difference between joint tenancy and tenants in common. So when you own a property, typically husband-wife will own a property in joint tenancy, which means when one person passes away, the property ownership transfers 100% to the surviving person, versus under tenants in common, if a person passes away, the ownership does not transfer to the other person. It goes to the estate of that person. So again, this is just, in discussions with other professionals, people seem to lean towards, if it's a tenants in common held property, that could probably push more towards a partnership relationship, which would require a filing versus a joint tenancy ownership. But again, we're hoping to get some more clarification on that. Looks like that's all the questions we have. So unless there's any more questions, again, you have our contact information on the screen there. Feel free to reach out to myself or Krista if you have any other questions. And I guess we'll wrap it up and have a good rest of your Tuesday. Thank you very much.
Thank you.